All right, yield nerds, we are on to episode 87, and I am going to become a true contrarian, and we'll see more about that. And I would love your feedback on whether you agree or not. All right, well, we have 200 plus subscribers now. Thank you so much. If you're joining on episode 87, that may or may not be a good idea, depending on how familiar you are with fixed income. There is a roadmap, which is a playlist. Please start there. It organizes the show in a sequential order. Moving on to my usual disclaimers. I do not profess to be an expert. I am just an independent learner sharing what I learned last week. This is not investment or tax advice. I don't have any agenda and I do not have any merchandise. And I certainly am not here to espouse one political opinion or the other. All right, this episode is going to be organized in 4 sections. Talk a little bit about where the shutdown is headed, which pretty much is a certainty now, and what does that mean. I'll share with you how I am approaching the shutdown in the next 3 months in terms of my asset allocation and my returns. And I have a moral that I'm taking to heart. I would love to share that and see what you think. So where are we with the shutdown? And I'm going to poke very gentle fun at AP News. There is an article called Shutdown, and then they throw every keyword possible, hoping clickbait would land on there. Shutdown McCarthy government funding Biden Trump Gates. So I guess I should call this Yield Nerd Investment Fixed Income. Please click. Having said that, they do a very good job of outlining what happens and what doesn't happen. And the list of people who are going to be asked to work unpaid starting in 48 hours. The military, how wonderful of us to ask the people who protect our country to work unpaid. They will get paid later when the shutdown is resolved, but hey, just work for no salary, okay? Law enforcement, very nice. Nice job thanking the people who keep law and order. Food aid, air traffic control. What could possibly go wrong with really angry, upset air traffic control workers? We're going to find out. The travel sector, just from the visa and passport issues, the travel sector is going to lose 140 million a day. And you look at that and go, oh my goodness, what is going to happen? And the article in AP News points out that the last time it happened, and it went on for 35 days, all of these amazing people working with no salary, the S&P index went up. That is pretty tone deaf, but this time may be different. I encourage you to Google what happened when the air traffic controllers striked about 40 years ago. At that time, they were striking because they wanted higher pay. It's a very different story. If something remotely like that happens this time, not because they want higher pay, they want to get paid for the work they do. I don't know where it is going to go, and we'll see. So how am I approaching a situation like this, end of the year, interest rates, Ukraine war, and the possible government shutdown and chaos? I admit I'm a little too far to the extreme on the fixed income side. 88%, it used to be 70 and then 80 and then 85. I've marched way down here between bonds with duration more than a year and bonds with duration less than a year, the T-bill side kind of bonds. 88% of my portfolio is in fixed income, and I have a small smattering here and there of equity and only small cap. I'm very big into small cap. Most of the value stocks tend to be small cap, at least using the filters I use. And so let's see how it did. Here are my returns, and this is a Schwab analysis called asset class performance. And first, I'll take credit for things that are working in my portfolio. You do you. If you use the value investment portfolio that I had sent before, I've discussed it in some of the previous episodes, you should be just as happy as I am. I am smoking the Russell 2000. I'm happy about it. In the fixed income portfolio, I'm again doing extraordinarily better than an average bond portfolio. And my cash investments, I don't just do 3 months. I mix it up 3 months, 6 months, 9 months, and so on. What is not working well? Well, the smart people who invest in the S&P 500, they have seen amazing returns year to date, even though if you go 12 months, I kind of sort of am there with them, but realize my equity portfolio is tiny. And So, all I will say is I'm getting 6.8-ish% investing only in the less than 10 PE, maybe 10, 12 PE ratio companies. I generally do a bunch of bonds. So I'm happy. Superstars who believe in Bitcoin and Tesla and Nvidia, and you guys are doing great. I'm happy for you. I hope it continues. Speaking of what continues and does not continue, the S&P 500 for the whole year has done phenomenally well. Although, looks like the last 3 months there are some rumblings. Ooh, the last month kind of doesn't look good at all. And I am again doing a little bit of a winners around in jest, and all kudos to the people who invest in tech stocks. I'm chugging along with 1.6 something return. Not a whole lot of ups and downs. I do take living expenses. I do take other extraordinary expenses out. So my actual return might be slightly higher, but who cares? We're between friends. All I am trying to illustrate is I don't have the enormous ups and downs. I kind of am a steady Eddie in that scenario. So how am I preparing for the next 3 months? Let me explain what I'm doing. Could the world be ending? And I'm going to be like that AP News article, throwing every keyword, hoping for clicks. And I'm going to put some scary music. Because the way in YouTube you get clicks is by talking about the world ending. Imagine that Bank of America has a giant problem. Look it up. Bank of America has 120 billion of treasuries underwater, mortgages that pay 0.25%, and those are underwater because interest rates have gone up, and that could catch up. Imagine Bank of America has trouble. The financial industry is destabilized from there. The shutdown keeps going on, and air traffic controllers say, I'm not going to work if you don't pay me. And airports shut down, the economy suffers, and everything comes to a crunching halt, and the Fed has to step in and say, oh my goodness, what am I going to do? I need to prop up the economy. This sounds like all bad news until you realize, that also means we may be at the peak of interest rates, and this may end up being hope and not despair. What am I talking about? Here's an article. This is called A Crisis is Coming. Who is Swimming Naked? I do not have any affiliations with RIA advice. I just love reading about this subject. You're welcome to look it up and read it yourself. It lays out the case in a very different way. The simple chart says every time interest rates rose meteorically, one way or the other, it broke something. And they break something, maybe some kind of a market crash, some kind of a financial crash, it could be the dot-com crisis. It doesn't matter which one. But when there is a very steep increase in interest rates, stuff breaks. And hello, look at what is happening here, an extremely steep interest rate increase. Having said that, there is another undercurrent. If you look at firms that cannot even afford their interest payment, if you took all of their profits and you tried to pay off their interest alone, there are about 20% of companies that can't even pay just their interest payments. That is just terrible. And this is what we filter out. This is the opposite of what we look for. We look for companies with huge cash flow. That is EBIT plus DA, earnings before interest after taxes. So you've paid off your taxes, but you have not yet paid your interest, if there is indeed debt. And then you add the depreciation and amortization, which are non-cash expenses. And so you look for companies with very high cash flow, and then say, I also don't like debt. This way, that is extra juicy cash that are available, the cash that is available to shareholders. That's what we look for. This is the opposite in the other end of the spectrum. And so this article from RIA shows that the percentage of companies that can't even pay their interest from their profits is seriously high, way higher than the 2008 great financial crisis. Good luck. Another thing they point out is, oh, by the way, what happens when there is a financial crisis or just before? Bankruptcies would start rising, and they say, hey, if you haven't noticed, we have the same problem now. Except here is the wonderful thing called the Fed. When the banking crisis happened this year, the Fed just invented a new program called BTFP. What is BTFP? The Fed said we can't afford for the banking system to collapse. So even if you have all these treasuries and if you have these assets that are underwater, you, the bank, are now allowed to borrow against assets underwater. What a great concept. And that facility is now at an all-time high. A third of that is Bank of America. And I'm not saying Bank of America is good or bad or ugly. I'm just saying once you open the door to protecting the system, you, the Fed, are now able to save the economy in the same way. If there is indeed a crash later this year, it is my humble belief that the Fed will invent yet another program to save the economy. And that opens the door for the contrarian in me. What do I mean by that? With the world worrying about shutdowns and wars and interest rates and inflation, I see an opportunity and I'm slowly starting to add duration. Let me explain more. These are my trades from last week, and I told you my portfolio is a whole bunch of short-term T-bills, and you can see I'm accumulating a lot around the end of March, and I have some in January. I certainly have a good chunk between now and the end of the year. But I want to point out a couple of things. I have started to buy longer duration agency bonds that pay a very, very healthy return. I do not expect these agencies to continue paying 6.7% to 10 years. I truly think they probably will end up calling these bonds sometime next year or the year after when interest rates drop. But hey, I will take 6.7% state tax free until then. Give it to me. And speaking of which, here is how my portfolio is organized. About a third of it are in the less than 90 days, another third of it are in a year, and the 1 to 5 years has some specific characteristics I'll tell you more about. But I do expect an equity crash, and I'm going to be patient. And what a wonderful way to be patient while earning 5.7%. And I did add state tax to it. So it's more like 5.3, 5.4 plus the 6% state tax break. And if you played Yield Super Bowl right now, the 6-month T-bill is the golden nugget. It pays 5.6%. So I have a big position on the 6-month T-bill ending at around the end of March 28th, something like that. I do have some duds from before Yield Nerd. I have some ETFs. I'm ashamed to say that I did not do my research early enough. But I am stacking the 1 to 5 years with more agency bonds. And then at the very, very top, the 10-year, I'm starting to accumulate some that pay 7% plus. These are callable bonds. That is how I'm playing it. I'm increasing duration. And there is a simple moral of the story that I take. Yes, of course, there is going to be a shutdown. Could there be an equity crash immediately? Maybe, maybe not, and I almost don't care because I'm going to sit on cash that keeps rolling into short-term treasuries. And if there is an equity crash, I will pivot to value investing. If there isn't an equity crash, no problem, good for the country. I will then look for bonds that pay a very healthy yield, and I will jump into longer duration bonds. If you gave me AAA rated bonds that pay 7%, give or take, state tax free, I will put everything on it and shut down this channel. Thank you very much. Oh, by the way, I also want you to keep inflation at 2%. Moral of the story, there is no specific number which is a magic number. If inflation is 5%, then earning 5% on short-term treasuries is pointless. So you have to always kind of keep through, when you're increasing duration especially, you have to think through what is the correct thing to do. So having said all of that, do not blindly follow me or any filter. Think wisely, and let's prepare for a rocky end of the year. Do your homework. Thank you for watching Yield Nerd. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.